You call the landlord. You have to maintain here. You have to maintain here. Relocation easy. If you want to move out, you respect the lease. It is very easy. So these are some of the advantages of renting. Now, talking about the disadvantages of renting. Maybe you rent 3-bedroom or 2-bedroom apartment. I want to tell you, first of all, you pay the rent. Your money is going to the landlord. You pay, the money is going to the landlord. So you don't build your own equity. So you don't have money coming to you. You simply pay the landlord, pay the landlord. So your money is going away. And less security. If landlord says, I want to sell my house, now you have to look for another place. So you are not really secured in terms of renting. You have to look for another apartment. Renovation restrictions. You cannot renovate the way you want. If you don't want the paint, maybe it is white, and you want red. You cannot paint in red. You have to ask the landlord. So renovations restrictions, or less privacy. When you stay in an apartment, maybe people above you or your neighbor, maybe they make a lot of noise. So now you call the landlord, my neighbor is making a lot of noise. So less privacy, no green space, of course, and less control over issues like pest, noise. For example, your neighbor may have bed bugs. So bed bugs can come from your neighbor, they come to you. You see? So these are some of the disadvantages of renting. So I talked about advantages and disadvantages of renting. But now I'm going to talk about buying a house. What are the advantages of buying a house? And what are the disadvantages of buying a house? So advantages of buying a house. First of all, you are proud. You have a place for your family. You say, yes, I bought a house in Winnipeg, in Canada. I have a house for my family. You are proud. And buying a house in Winnipeg, it's a great investment. By great investment, I mean you buy a house maybe 200,000. Maybe within 5 years, do you think the price will be 200,000 or more? Depending on how you maintain your house, normally, usually, the value of your house is increasing every year increasing, usually. But not always, depending on how you maintain your house, depending on so many issues, anything can happen. And the price of the house drops. But usually, when you buy a house, it's an investment. The value is appreciating. It's going up every year. But as I said, anything can happen, or maybe you don't maintain your house and no one wants to buy your house, then it can depreciate, it can go down. But usually the price is going up, it's going up. So buying a house, it's an investment. And you have also more space and you have more control with renovations decisions. But make sure you respect the city rules, the city codes. Now, talking about the disadvantages of buying a house. So if you buy a house, you have more responsibilities. You have to clean the backyard. You have to plant the flowers. You have to shovel the snow. You have to cut the grass. You have more responsibilities. And harder to move. If you want to move out, you have to sell your home, your house. You need to sell it. Sometimes it can be very quick, but sometimes it can take time to sell a house. And when you buy a house, higher costs. Before I talk about this one, I want to talk about renting. When you rent, sometimes you pay only the rent and utilities are included, the heat, electricity, and water. You pay the rent, everything is included. But sometimes utilities are not included. You pay the rent and utilities. That's it. But look here, when you buy a house, you pay the mortgage payment. This is the amount of money you pay every month. Bank or credit union will tell you how much to pay every month. These are called mortgage payment. You pay, remember, you pay towards the principal and you pay towards the interest. These are mortgage payment. Amount of money you pay every month. And if something is broken, you have to pay for the repairs. You will not call for landlord. You are the owner. You pay for the repairs. Maintenance. You pay for insurances. We are going to see in a few seconds which kind of insurance do you pay. You pay taxes, property tax to the city of Winnipeg. You pay utilities. You pay the heat, electricity, you pay water, and so on. You pay phone, cable, internet, and so on and so on. So, buying a house, you have to be aware of all these higher costs. Some people are saying, oh, now this is too much. Renting is simply paying the rent or paying the rent plus utilities. But buying a house, I have to pay all this. Some people say, oh, now I will rent, I will not buy a house. But remember, at the beginning, I said, if you rent, you simply pay, your money is going to pay the rent, You are not building equity. But buying a house, it's an investment. And now, you, as I said, you have to maintain your house, you have to cut the grass, you have to shovel the snow, you have to remove leaves on roof, and so on and so on. So these are some of the disadvantages of buying a house. I just told you that I'm going to talk about insurance.
Oh, dear, please.
Yeah? So, property insurance. You must buy property insurance. Even before the bank will release the money, the mortgage, you must have this insurance. Why do we buy property insurance? It's a must. So this insurance will cover in case of maybe there is a fire. You go to work, you come evening, oh, fire. Insurance will cover. flood, water, or people can come, theft. They can come break your house. Anything can happen to your house. So this insurance will cover in case of those problems. So you buy it, you can buy from any insurance company. Property insurance, it's a must. And there is another insurance, mortgage life insurance. This is the insurance of your mortgage. This one is not a must. It is optional. For example, in a family, maybe the husband buys this insurance or the wife buys this insurance. Suppose, let me say, maybe the wife buys the insurance and you buy a house, maybe 2020, in this year. You pay the mortgage. Maybe the value of your house is 200,000. You pay your mortgage. Maybe after 5 years, the person who has insurance, the wife, something happens and she dies. She dies. What will happen to your house? Maybe the balance on your mortgage, maybe after 5 years, maybe it is 140,000. So if the person insured, in this case, if your wife passed away, then insurance companies, they will go to the bank or credit union. They will ask, how much is the balance? And the balance, 140,000. So they pay everything. Now the family members or the beneficiaries, they will enjoy the house, of course, without the other person. The house will be paid. So if the person who has insurance, you buy a house in 2020, house of 200,000. Maybe the husband has bought the mortgage insurance. So pay the mortgage. Maybe after 10 years, maybe the balance on your mortgage, maybe it is 100,000. Then something happens to the husband and the husband dies. In this case, the insurance company will go to the bank or credit union. They pay the balance. They will pay only 100,000. So if you have the mortgage life insurance, the insurance company will always pay the balance. They will go to the bank or credit union. They pay the balance on your mortgage. There is another insurance, term life insurance. Yes.
It's Cody. I just wanted to, we have a few questions coming in.
Yes.
So we have the first one is, do you have to pay property insurance if it's a condo?
If it is a condo, yes, you pay property insurance.
Perfect. And the next question was, so on life insurance, what if somebody does not have life insurance and they pass away? Are they going to take the house?
Yeah, if somebody passed away and there is no mortgage life insurance, then if the wife or if it is a husband who passed away, if the wife can pay the mortgage, that's okay. But if nobody cannot pay the mortgage, then they will take the house.
Yes, absolutely. You have to have insurance to cover that mortgage. Yeah.
Yeah, if there is no insurance, then they will come and take the house.
Wonderful. Okay, that's all my interruptions for now. Keep going.
Okay, thank you.
Thank you, Darius.
Yeah, there is a term life insurance. It is also optional. It's not a must. Then, as I said, property insurance is a must. Mortgage life insurance is optional. Term life insurance is also optional. It's not a must. But suppose in a family, maybe the husband buys this insurance, and the coverage for this family, the amount of life insurance coverage, it depends on your family. It depends on how many children, your age, if your health, it depends on so many things. But suppose the life insurance coverage for this family maybe 250,000. Then this family, they buy a house of 200,000 in 220 this year. And they pay the mortgage. Maybe after 5 years, maybe the person who has insurance, in this case, we said the husband. If the husband passes away, if the husband dies, then what will happen? The life insurance company will take the 250,000. They don't go to the bank to pay the balance. They go to the family, to the beneficiaries, to the family members, beneficiaries. And they give them 250,000. Now, this family, the beneficiaries, they are going to receive this amount of money. They may decide either to go to the bank or credit union and pay, or they may decide to go to US and enjoy the money. This is their money. So mortgage, life insurance, they go to the bank or credit union, they pay the balance. But life insurance, they go to the beneficiaries and they give them the amount of coverage. This is the difference. And if you want on mortgage life insurance, if you want to add critical illness or loss of job, you can add this. But remember, if you add critical illness or disability or loss of job, so the premium will be higher. So you are going to add more money.
Azarias, one more question about insurance.
Yes.
We had a question about, so mortgage life insurance is optional, but
Yes.
Is it a condition of the bank or credit union to approve your mortgage application?
No, it is not a condition.
Yeah.
It is optional.
Yeah.
Yeah, to approve doesn't depend on either you have a mortgage insurance or a life insurance.
Mm-hmm.
Yeah.
Great, thank you.
You can be approved without this insurance. All right. So now, before you buy a house, I'm advising you, don't rush. Don't look at one house, yes, I buy this one. I encourage people, if you want to buy a house, can you have a meeting in your family? Have a meeting in your family. If you are the husband, wife, and children, if you have children, have a meeting in your family and discuss which kind of house do you want to buy. Discuss in a family. Do you want to buy a condo? Do you want to buy side by side? Do you want to buy a bungalow? Do you want to, so discuss. For example, do you want one level, 2 levels? Depends on your family. And think about maybe what will happen to you within maybe 10 years, 15 years. Maybe some people, some children will move out, or you will have more who will come in. Think about it. Think about the separate kitchen. You know, in my culture, we don't like when the kitchen is here and the living room is open. It's just close to the kitchen. We don't like that. We like when the kitchen is hidden, when there is a wall in between. But for many houses here, you will see the kitchen and the sitting room or living room, it's open. So think about it, if you like it or not. Discuss in a family. And think about how many bedrooms do you want? How many bedrooms do you want? Think about how many outdoor do you want? Think about the basement. So if you want to make bedrooms in the basement, make sure it meets the codes. By codes, I mean the city codes. I mean, if there is no window, nobody should sleep in the basement. If no window, nobody should sleep in the basement. This is because of, for example, in the case of a fire, people should escape through the window. If there is no window, then people will die in the basement. So make sure there is a window in the basement if you want people to sleep in the basement. And discuss in a family. Do you want to buy a house close to the services, close to the temple, close to the church, close to the parks, close to the schools, or close to the bus stop? So think about this. Or do you want to buy a condo or a house? And of course, buy what you can afford. Think about the parking for your visitors. I remember one person bought a house and he invited us. Come, we are going to celebrate. So we went driving and we asked him, where are we going to park? He said, park on the street there. But the parking was just 1 hour, 1 hour. So every time we have to look on our watches, or we have to go out, move the car. And you see, and he said, I didn't check this. Can you please check everything, even the parking for your visitors? Yeah, and think about the area of the city. Do you want to buy a house in downtown, Pembina, St. Vital, St. Boniface, Kildonan? So think about the area of the city. How many bathrooms do you want? Yeah, think about the bathroom. I remember there was one family, they bought a house, 8 people in the family, and 1 bathroom. So in the morning, line up. And they said, oh, we didn't check bathrooms. We said now, oh, it is too late now. So we advise people, before you buy a house, check everything. Discuss in a family, which kind of house do you want to buy? And if you are ready, you know which kind of house do you want to buy, you discussed in a family, now look for a mortgage. Mortgage. You can get a mortgage from the bank or from the credit union. Some people are not aware of credit unions. So you can get a mortgage from the bank or from the credit union. So what is a mortgage? This is a long-term loan to buy a house. Long-term loan to buy a house. And the house you buy is considered as collateral. Collateral, I mean, it's like a guarantee. If you don't pay back, if you don't pay your mortgage, bank or credit union, they have no problem. They have the house. The house is like a guarantee. They are going to take their house. So collateral is like a guarantee. If you buy a house, if you don't pay the mortgage, now they have the house as a guarantee. They are going to take the house. Then, of course, the value of that house must be more than the amount you will borrow from the bank or from the credit union. Because if you don't pay, they are going to take the house and sell the house. So they cannot give you more than the value of your house. the value of the house must be always more than the amount you borrow from the bank or from the credit union. And if you want a mortgage, so the mortgage will be, it's a legal document and it is registered against the title of your property. You have a title of your property. And if you are looking for a mortgage, I said you go to the bank or credit union, you negotiate. You negotiate. What do you negotiate? First of all, negotiate the best interest rate or the lowest interest rate. Or the banks or credit union, they don't have the same interest rate. So look for the lowest interest rate. And remember, as I said, the bank or credit union, they will let you know how much you have to pay every month, every month, every month. So ask them, if I get a better job or a second job, can you pay more than what they ask? For example, if they tell you to pay every month, maybe 800 every month, ask them, if I get a better job or a second job, can I pay more than that? They will allow you to add extra money between 5% to 20% per year. 5% to 20% of the principal per year, not per month, per year. You can add this extra money without a penalty. But if you add more, you will get a penalty. So they are not doing business. Remember, it's a business. If you add more money, they are losing. They don't like that. But they will allow you to add extra money between 5% to 20% of the principal per year. So you can, if you are looking for a mortgage, you can even check to maybe 2 or 3 mortgage specialists, talk to them before you decide. As I said, you can get a mortgage from the bank or from the credit union. So once you get a mortgage, you pay every month, every month. You pay regularly, every month, every month. You pay, remember I said it, you pay towards your principal and interest. And if you want to buy a house, you must have cash money, and this will be towards your down payment. Down payment. This is the amount of money you pay, and the minimum is 5%. Minimum 5%. So if you have less than 5, you cannot get a mortgage. They will advise you to save more money, up to 5%. If you have more, it will be very good. Because once you pay more, the interest will go down. You reduce the interest. So if you have more money, pay more. Interest will be reduced. But otherwise, the minimum is 5%. Minimum down payment is 5%. So there is what we call amortization. Some people are asking how many years you are going to pay off your mortgage. How many years? Some are saying 10, 15, 20, but maximum period, it is called amortization. So this is the length of time you are going to pay off your mortgage. You are going to finish your mortgage. And maximum is 25 years. 25 years. You are going to finish your mortgage. I know it's a long time. Yeah, but remember, it's a lot of money. As I said, it is the maximum. But you can make it shorter. Maybe pay within 20 years or 15 years. How can you do that? Remember, I said you have the room. You can pay extra money. So if you want to make it short, pay more. Pay more money. So the shorter the period, the higher the mortgage payment. If you want maybe 20 years or 15 years, pay more. And by paying more, you reduce the interest. Interest will go down over time. You can do that. You have the room. And within the amortization, you have what we call terms, the term. So you go to the bank or credit union, you negotiate the interest rate within the term. So within amortization, the 25 years, you choose a term. Most common is 5 years, but the term can be from 6 months to 10 years. But the most common is 5 years term. You can choose shorter, maybe 1 year or 2 years. But the most common is 5 years. 5 years interest rate. So you choose within 5 years interest rate, or it depends on you. You can choose a shorter term, and the shorter the term, the lower the interest rate. If the term is maybe 1 year, now interest rate will be lower. So if you choose a shorter term, you are going to have the lower interest rate. But suppose you choose 5 years term, 5 years term. So within 5 years term, you are going to negotiate the interest rate. There are 2 kinds of interest rate. 2 kinds of interest rate. The first one is variable interest rate.
Hey, Zarius, sorry to interrupt you again, but just on the 5-year term question, we had a few questions come in.
Yes.
When it's time to renew your mortgage, so let's say they had a 5-year term, do you think it's better to go with the 5-year fixed or wait to see if the interest rates go down? Not sure if you have a good answer for this one.
So I'm going to talk about interest rate, fixed or variable.
Okay.
So fixed or variable, this is coming. And so if you choose the term, for example, 5 years, I said most common 5 years, but you can take lower. Within 5 years term, suppose you choose fixed interest rate. Now interest rate is very low, around 2.7 or 2.8 is very low now. Suppose you choose fixed interest rate within the term, 5 years. Now you are going to pay the same amount up to 5 years, up to the end of 5 years. What do you do after 5 years? Now, after 5 years, you will see, they will send a letter to you telling you this is the time you have to renew your term. So you go to the bank or credit union, you renew. Either you take fixed again, or you can take variable. It depends on you. But suppose you take variable interest rate within maybe 5 years. So interest can go up or can go down, variable. Interest can go up or down, up or down, up or down. So between variable and fixed, think about it. You can even ask specialist. How do you see the trend? How do you see it? Is it better to take a fixed or variable? So the decision is yours. I'm not going to tell you go and take variable always or take fixed always. Think about the two, fixed interest rate or variable interest rate. Think about it. And yes?
Sorry, we just had one more question about amortizations. And
yes.
Is there a minimum amount of time to pay off your mortgage?
So the minimum, I always receive this question when I do the home purchasing presentation. So the minimum, even if you have cash, if you have cash money, if you came from home or you have cash money, you are ready to buy a house, you can buy a house. But if you are looking for a mortgage, now it depends on your terms, you and your bank or credit union. What are the terms now of your mortgage? But the minimum, even today, if you have cash money, you can buy a house. I don't know if I have answered his question or her question.
Yeah, no, that's good. Just the big thing is making sure what the terms of your mortgage are, and you can talk to the bank or credit union and say if there's any penalties if you pay it off too soon, those types of things. But yeah, if you had $200,000 today and you went and bought your house, you could buy your house today, right? Yeah,
you can buy the house today. So the minimum time, even today you can buy. If you have the money, you can pay.
Yeah.
Thanks, so this is variable or fixed. At the end of your term, you have to go back to the bank or credit union, negotiate again the term. Maybe you can change, maybe you can take 2 years or 3 years, or it depends on you. Now, talking about open and closed mortgage. When you are looking for a mortgage, you must choose one, either open or closed. Suppose you choose open mortgage. If your mortgage is open and the bank or credit union tells you that you will pay $800 per month, just an example, $800 per month, $800. Now, if you win a lottery, you play lottery and you win 100,000, you can pay even tomorrow. Your mortgage is open. But if your mortgage is closed, remember, the bank or credit union will tell you how much to pay every month. Suppose they tell you pay $800 per month. Then, remember, you can add extra money, only between 5 to 20% per year. So this is a closed mortgage. If you want to add extra money, you are going to pay a penalty. So this is between open mortgage, you can add any amount. But closed mortgage, you are limited. You can add extra money between 5% to 20% per year, not per month, per year. And people are asking me, which one is better, open mortgage or closed mortgage? I once again will let you know the choice is yours. Think about it. If you want open, you can even pay off tomorrow. But think about the bank or credit union. Remember, as I said, it's a business. If you can pay off tomorrow, what will happen to the bank or credit union? They are going to lose money. So how do you think between the two, open and closed mortgage, how do you think about the interest rate? Of course, open mortgage interest rate will be higher because at any time you can pay off your mortgage. So open mortgage interest rate will be a little bit higher, closed mortgage It will be the usual one. So remember, fixed, variable, open and closed mortgage. Then talking about the mortgage default insurance. Mortgage default insurance. For example, if we buy a house in 2020, maybe a house of 200,000. So you pay the mortgage, you pay the mortgage, you pay the mortgage. Maybe after 5 years, something happens to you and you cannot pay your mortgage. Bank or credit union will work with you. They will ask you, what's the problem? What can we do? What is happening? They are going to work with you to see if you can continue to pay your mortgage. Maybe they can, it depends on banks or credit union. It can take time, maybe 2 months or 3 months or 4 months. They are going to work with you and see if you can continue to pay your mortgage. Suppose you cannot pay your mortgage. What will happen to your house? Remember, we said your house is a collateral. It's a guarantee. Now, bank or credit union, they are going to take your house. Because you cannot. They've tried to work with you and finally you cannot pay your mortgage. So now they are going to take your house. What are they going to do with your house? Of course, they are going to sell your house. Remember, at the beginning, I told you buying a house, it's an investment. Usually, it's an investment, but not always. Suppose now they want to sell your house. Now, people are coming to look at your house. They want to buy. And maybe you didn't maintain your house. Maybe your house is in a bad condition. And maybe the bank they want maybe 140,000. This is the balance on your mortgage, 140,000. Now, suppose they sell the house. It can happen. Suppose they sell your house, maybe 120, and they need 20,000 more. They need 20,000 more. Who will pay this money? So the previous owner, you have lost your house. They are not going to come after you and say, come, we need 20,000 more. No. Who will pay this money? The government will pay this money. We have a good government. They will pay this money. So the bank and credit union, they will go to the bank and say, they will go to the government and say, we have a problem here. There was a mortgage default and we sold the house and we need 20,000 more. So the government will pay. Now, the government, to pay this, they said to potential home buyers, they said, if you want to buy a house, if your down payment is between 5% to 20%, less than 20. If your down payment is between 5% to 20%, but less than 20%, you must pay insurance. Mortgage default insurance. And this insurance is one-time payment, one payment only at the beginning. One payment only, and we have to do it at the beginning. So how can you avoid to pay this insurance? How can you avoid to pay this insurance? I said, if your down payment is between 5 to 20, you must pay the mortgage default insurance. So you can avoid to pay this insurance if you pay down payment. If you make down payment 20% or more. If you make 20% or more. So you don't pay this insurance. And suppose you don't pay this insurance. Maybe you pay 30% or 20%. You don't pay this insurance. And you have a problem. You have a problem, you cannot pay your mortgage. The bank will take your house. They need 20,000 more. So even if you did not pay this insurance, the government will still pay the 20,000. Even if you didn't pay towards this mortgage default insurance. And as I said, it is one-time payment and you pay it at the beginning. There are mortgage default insurance providers, 3 of them. Mortgage default insurance providers. There is CMHC Insurance, Canada Mortgage and Housing Corporation Insurance. There is another one, mortgage default insurance provider, Genworth Insurance. There is another one, mortgage default insurance provider, Canada Guarantee. These are the 3 mortgage default insurance providers in Canada. And make sure to ask your financial institution which provider works with it and what makes it different from others. Maybe CMHC Insurance provider or Canada Guarantee or Genworth. What makes them different? Ask your financial institution and ask them which provider they work with. And as I said, this is one-time payment. I can give you an example of CMHC Insurance, Canada Mortgage and Housing Corporation Insurance. So how much do you pay towards this insurance? Once again, one time. On the screen, you can see it. Let me start, you see a table there. Let me start from the bottom. You see, if your down payment, you see 90%, 90.01 to 95% at the bottom there. If your down payment is to make 100, 95 you add 5, and 90 you add 10 to make 100. So if your down payment is between 5% to 10%, 10%, and your down payment is non-traditional down payment. What does it mean, non-traditional down payment? So if your down payment, maybe you want to buy a house and you don't have cash money. You go to maybe your mom or your friend or your dad and you tell him or her, I want to buy a house, but I don't have cash money towards my down payment. Then your mom says, okay, my son, take 10,000. Go and buy a house. Maybe you want to buy a house of 200,000. 5% is 10,000. Then your mom gives you 10,000 towards your down payment. It's a gift. Now you go to the bank, you say, I have a gift, 10,000. First of all, they will ask you the bank statement to see how much money do you have towards your down payment. If they see 10,000 deposited on your account, they will ask you, how did you get this money? You said, this is my mom gave me a gift. Now they will say, you want to buy a house and you don't save money towards buying a house. So you are a risk to the bank. They are going to charge you maximum CMHC insurance, 4.5%. Or if you take your down payment from your line of credit, so now they will charge you Canada Mortgage and Housing Corporation insurance, the maximum 4.5% of the total loan. The total loan. I explain. Suppose you want to buy a house of 200,000. You get a gift from your mom of 10,000, 5%. 5% of 200 is 10,000. So you give 10,000. The loan will no longer be 200 because you pay 10,000. The total loan will be 190,000 because you pay 10,000. So now they calculate CMHC insurance. They take 4%, 4.5% of your total loan. So the loan will be 190. 4.5 times 190,000 divided by 100. It will be 8,550. So 8,550, this is the amount of money you pay towards the Canada Mortgage and Housing Corporation insurance. And it is one time. But if you don't have this cash money, you say, oh, I don't have cash money. They will say, no problem. Don't worry. They will add to your mortgage. Your mortgage, remember, is 190,000. So they will add 8,550. So your new mortgage will be 100,098,550. But if you have cash, pay. If you don't have cash, no problem. They will add to your mortgage. I remember when I bought my house, I didn't have the CMHC insurance. So they said, don't worry, they added to my mortgage. But if you worked and saved money, now you have saved, for example, you see there 95. To make 100, you add 5%. You add 5. So if you save the money, 10,000, now your CMHC insurance will be 4% of your total loan, 4% of 190,000. If you save the money, 10%, you see there 90%. 90, you see it is 3.1. If you save the money, you want to buy a house of 200,000, but you pay 10%. 90 to make 100 is 10%. So if you add, you pay 10%. 10% of 200 is 20,000. If you pay 20,000, now your CMHC insurance will be 3.1% of, because you paid 20% of 180. You pay 20,000 minus, you see, the 200 minus 20,000 will be 180,000. If you pay 15%, 15% of 200,000 is 30,000. Now, you pay 30,000. The CMHC insurance will be 2.8% of 170,000. So this is how they calculate the CMHC insurance, just as an example. So remember, if you are working with the bank, ask the bank. If they work with, ask your financial institution which provider works with it and what makes them different. Is there any question? Otherwise, we are going to finish here by mortgage default insurance. Once again, yes?
Azarius, there are so many questions. Are you ready?
Yes, yes, yes.
I have been writing down everything. So we are going to start. Thank you for all your questions, everyone. So here we go. We'll just keep on the CMHC insurance. Is there any extra interest that you have to pay if they add the CMHC insurance to your mortgage?
Yes, because your new mortgage will be your loan plus the amount of CMHC insurance. In fact, it's a loan they give you. Mm-hmm. So they are going to, interest will be higher. It will be more. They are going to charge you more.
Yeah. Another question on that front is, if somebody gives someone a gift of money that would cover 20% of the cost of the house, do they still have to get CMHC insurance?
If you pay if you pay 20%, then you don't pay CMHC insurance. 20% or more, you don't pay it. You pay the CMHC insurance if it is a gift, 5 to 10%.
Right.
Yeah.
Yeah. Once you hit the 20% mark, you don't need mortgage default insurance anymore.
Yeah, 20% or more.
Right. Then you're not risky in the bank's mind.
Yeah.
Another question about if someone's in an open mortgage and they want to increase their regular payment by, I think you said about 5 to 10%, like whether that's a lump sum or something like that. Is that 5 to 10% the total cost of the house, 5 to 10%, or total cost of the monthly payment?
5 in an open mortgage, I repeat again, open mortgage, you can add any extra amount, because your mortgage is open. But in a closed, if your mortgage is closed, you have the mortgage payment. Suppose you are told to pay $800 per month, every month. If you get a second job or a better job, you can add extra money between 5% of your principal, 5% to 20% per year of the principal.
Principal, yeah.
Yeah, not of the monthly payment.
Right.
On the principal.
Another question, this one's about a closed mortgage. So let's say you want to pay a lump sum against your mortgage, but there might be a penalty associated with that. Is that penalty on the amount of the lump sum or based on the amount that you have left owing on the mortgage?
Based on the amount left on owning the mortgage.
Okay. Yeah. Perfect. Sorry, I'm just scrolling through here for a second. Is there room for a return of premium for mortgage insurance after paying off the mortgage? Wonderful question. I wish. No,
there is no room of returning the insurance.
No.
Yeah. No.
The government keeps that money.
Yes.
Okay, sorry, another question here. If you pay 20% and you don't pay for default insurance, so mortgage default insurance, and you default in your mortgage payments, what will happen after that? Good question.
So they will still pay the amount the bank or credit union needs, even if you did not pay towards this insurance. Oh. They will still pay. Yeah, because you paid 20 or more. Yeah, so they will still pay even if you did not contribute, even if you did not pay for this insurance.
Right.
Yeah.
And we had a question a little bit back. You've probably answered this, but just to clarify the difference between mortgage life insurance and mortgage default insurance.
Mortgage life insurance, it is when, for example, you buy a house of 200,000 and either the husband or wife buys a mortgage life insurance. This is the insurance of the mortgage. For example, maybe the husband buys this insurance and they pay the mortgage. Maybe after 5 years, so the husband dies. Then, and the balance on the mortgage, if the balance on the mortgage may be 140,000. Now, if the person who has insurance, in this case, the husband dies, then the insurance company, mortgage life insurance company, will come and pay off the mortgage, pay off the balance. Then the beneficiaries, they are going to enjoy the house. It is paid. Yeah, it is paid. But the other insurance, she wanted the difference. But the mortgage default insurance, it is when you cannot pay your mortgage. You cannot pay your mortgage, then the bank or credit union will come work with you. What happened? Can you pay the mortgage? Maybe 1 month, 2 months. Can you pay the mortgage? If completely you cannot pay your mortgage, then they are going to take the house. Suppose on the house, the balance you owe to the bank or credit union is maybe 140,000. And the bank or credit union, they take the house, they sell the house. Maybe they sell the house by 120,000 and they need 20,000 more. That is when the mortgage default insurance, they are going to pay the 20,000 more. They are going to pay the bank. So this insurance, mortgage default insurance, it protects the lender. They protect the lender, the bank or credit union. They are protected. They are not going to lose money. If they have a problem, they will go to the government or to CMS Insurance or Canada Guarantee or the Genworth. They say, there is a problem here. They are going to be paid. They have no problem. So this insurance protects the lender. Any other question?
Yeah, just another one on insurance stuff. So there's a house for, let's say, a couple, and one of them passes away, but the other person's still alive, but the insurance will still cover the mortgage, right? Even if one person's still alive and able to make payments?
Which kind of insurance?
Life insurance.
The life insurance.
Yeah.
So the life insurance, the coverage, if the person who had the life insurance dies, then now they are going to get the amount of life insurance coverage.
Yeah.
They are going to give to the family, to the beneficiaries. Now, if they can continue to pay the mortgage, that is fine. They can continue to pay the mortgage.
Right, but they could get paid out for all of that life insurance.
Yeah, they can pay off. It depends on the terms of the agreement.
Yeah.
If it is closed or open mortgage.
Right.
Yeah.
Right, for sure. And then, so one final question, but I think maybe you can answer this, and then also promote the home purchasing workshop part 2. The question was about, what is the effect of paying your mortgage payments bi-weekly?
Oh, we are going to talk this one in part 2.
Yeah.
So these are possibilities of reducing the interest rate. So we will talk about all this, because when you buy a house, you have to be very smart. And you have to play on interest rate. You have to see the ways you can reduce the interest. So we are going to see ways of reducing or possibilities of reducing the interest rate. And Paying bi-weekly is one of them. So to pay bi-weekly, you are going to save a lot of money by simply paying bi-weekly. But we are going to see in the second part. The second part, we are going to see that we have an example of a family, they want to buy a house. We are going to see the credit history. We are going to talk about interest. We are going to talk about realtors, real estate agent. We are going to talk about offer to purchase, ways of reducing the interest, and everything, so many things. So I really will advise you to come for the second part. We will talk about all this.
Wonderful.
And it will also be 1 hour.
Yeah, wonderful. We don't, the date will probably be a week from today. We seem to be doing workshops on Wednesdays at 2. We haven't quite advertised it yet, but if you're on our email list or follow us on Facebook or Instagram, we will have all the information on there. One last question for you, Azarias, just to your opinion. The interest rates are quite low now due to COVID-19. Is it right to say that now is a good time to buy a house?
So once again, I give you information. The choice is yours. Think about it. Is it the right time now? And as I said, can you ask a specialist? Do your research. Do a little bit of research. Ask a specialist. Is it now the right moment, the right time? Is the interest going to go lower and lower, or is it going to go up? Or think about it. Ask a specialist. But for me, I will give you information. The choice is yours.
That's great, Azarias. Yeah, and the big thing right now is how stable is your income, right? Because if you buy a house, but if you're going to get laid off or whatever, that's the tricky part, because owning a house, you might have the money today, but right now is kind of uncertain times. So you have to think about all those things too. Yes, interest rates are low and house prices might be a little cheaper, but you've got to make sure that you can cover your monthly costs and be able to save a little bit more money as well for those unexpected costs that are going to come and hit you. So, oh, sorry, one more question. If anybody has to leave, you're welcome to leave, but question she's coming in. Where is it better to buy a house, rural areas or in the city? I love this question. I'm from a small town, so I'll let Azarias go first.
Remember in the rural area, houses may be a little bit cheaper than in Winnipeg here. But it depends on your plans. If you are planning to go to the rural area, that's fine. If you are planning to get a job over there, that is fine. And the houses are cheaper there, just a little bit cheaper. But here in Winnipeg, they are a little bit expensive. But all this depends on your plans and what you are thinking about your family and what you are planning to do. But of course, in the rural, it's a little bit cheaper than in Winnipeg.
Yeah, I will say, just because I'm from a town of about 1,500 people, so very small little town. It's 3 hours away from Winnipeg. Yes, house prices are cheaper. It's wonderful growing up in a small town, one school, you know a lot of people. Obviously, job opportunities are a little bit less, maybe, depending what your area of work is. But everything you need is in the town: banks, grocery stores, school, library, those types of things. So if you have any other questions about living outside of Winnipeg, send me an email. I will definitely help you out with that. And there are settlement sector members that are in rural communities that help newcomers to Canada settle in smaller towns. So if you want any of that help, I am more than happy to give that to you. I know living in a city isn't for everybody. So I get it. So send me an email. I've put my email in the chat. Cody, CODIG @newjourneyhousing.com. I also put Azarias' email, and everything is also on our website too. Sorry, I'm just quickly reading this chat in terms of what, if you want to sell. Oh, Swan River. Lovely. Sorry, Sally, I'm reading your comment here. Okay, yeah, lots of communities. Newcomers are settling all over the province. Steinbach, Neepawa, Portage, Altona, all these nice little towns. So ask me, you can send me an email. Nikki's asking for research on the bank that offers the lowest interest rate right now. Yeah, we can find out some of that information for you too. But it should all be on the banks and credit unions, their website. They will make their interest rates front and center. You'll be very easy to find it. So I think that's it. This has been great. Lots of good information shared, lots of awesome questions. And keep your eye out for the registration link for when our next workshop is going to be. And you're welcome to send us emails, ask us follow-up questions. That's all good. But thank you all for coming, and lovely to chat with you all. You kept me busy. And Azarius, thank you as always for your brilliant mind and all your knowledge on buying a house.
Thank you very much.
So that's it. Have a good day, everybody, and stay safe.
Thank you, Cody.
Okay, bye.
Bye-bye.